Hello, this is Gaurigal. Let us begin with general introduction. Business transactions are recorded in books of accounts to know the profit and loss of the business and also to have a financial position of the entity. To know the profit and loss earned, the assets and liabilities of the enterprise, two statements, namely profit and loss account and balance sheet respectively, are prepared at the end of every financial year. The collective name given to these two is known as financial statements. It is also known as annual accounts and final accounts. What are the features? See, features of financial statements are expressed only in monetary term. The qualitative aspects like the potential strength of employees, the loyalty, the creditability, etc. are ignored. Thus, non-monetary events and assets are ignored by financial statement. They always present the past performance. Thus, they are historical in nature. They do not consider future. Financial statements are prepared by covering only limited time period. Generally, it is a year. Now, what do you mean by final accounts of a sole proprietorship? See, final accounts comprises of three statements: trading account, profit and loss account and balance sheet. Moving ahead, let's discuss these in detail. Trading account is practically a part of profit and loss account. It is prepared to find out gross profit or gross loss. Now, what is gross profit? It is sale proceeds of the goods minus the cost of the goods sold. Net purchase of goods and direct expenses incurred by business are shown on the debit side of the trading account. And these direct expenses includes wages, carriage inwards, freight, import duties, octroi, royalty, packaging materials, fuel used for production process and commission on purchase, etc. incurred to bring a product to saleable condition. Opening stock, which is lying with the entity in the beginning of the year, should be debited to the trading account, while closing stock at the end of the year should be shown on the credit side of the trading account. Net sales made by the enterprise and any other outflow of goods from business by reason other than sale. Here, the goods are distributed as samples, goods given in charity, goods burnt by fire, goods withdrawn for personal use, etc. are thus credited to the trading account. Goods going out of the business by any other reason other than sale should be recorded at cost. Now, the closing entries for trading account are: for closing purchases account, trading account is debited to the purchases account. For closing purchase return account, purchase return account is debited to the purchase account. That is, net purchases are shown in the trading account. Purchase return are shown as deduction from purchase instead of being credited to the trading account. And for closing sales account is debited to trading account. For closing sales return account is debited to the sales return account. Meaning, net sales are to be shown in trading account. The sales return are subtracted from sales on the credit side instead of being debited to the trading account. And for closing accounts of direct expenses, trading account is debited to wages account, to carriage inward account, to import duty account or to other direct expense account. And closing stock is, see, goods lying unsold at end of the year is closing stock. It is to be valued at lower of cost or net realizable value of goods as per principle of conservatism. For recording closing stock into books, following entries are passed. Closing stock account is debited to the trading account. This entry has two effects: closing stock accorded on credit side of trading account and closing stock being an asset recording on the asset side of the balance sheet. Opening stock, in order to cancel the adjustments, entry of the closing stock of previous year, a reverse entry is to be passed to rectify the effect at the beginning of the year. So, trading account is debited to the opening stock account. Net balances means gross profit or gross loss. So, after passing all the entries listed above, the balance of trading account is worked out. If the total of the credit side is more, it shows that the income is more and therefore there is profit. The positive difference is thus called gross profit. Trading account is debited to profit and loss account. If the total of debit side is more, it shows that cost of goods sold is more than the sales price realized. It is negative difference, which is called gross loss. It is recorded as profit and loss account debited to trading account. Now, let us see the format of trading account. Let's discuss profit and loss account. Profit and loss account is prepared to ascertain the net profit. Net profit can be said to be the profit earned by the entity from the business. It measures the net income by matching total revenue and total expenses of the business enterprise. Generally, indirect expenses relating to administration and selling and distribution of the firm that are not directly related to production are debited to the profit and loss account. Indirect expenses generally includes administrative expenses. These expenses incurred to administration, that is an office or business expense, for example, salaries, taxes, rents, electricity charges, insurance, audit fees, postage, etc. Selling and distribution expenses, expenses incurred on making or increasing sales are selling expenses, and expenses incurred to dispatch goods to customer are called distribution expense. For example, publicity expenses, salesmen salaries or commission, discount given to the customers, carriage outward, packaging expenses, bad debts, etc. Financial expenses, expenses incurred for procuring finance for business are financial expenses. For example, interest on loan, bank charges, discounts on bills, etc. Then maintenance expenses, expenses related to maintaining of assets are maintaining expenses. For example, repair charge, depreciation, etc. What is abnormal loss or gain? Abnormal losses faced by a firm on an unlikely event, for example, loss on sale of fixed asset, loss due to fire, etc., should be debited to the profit and loss account. Abnormal gains such as insurance claim exceeding cost, profit on sale of fixed asset should be credited to profit and loss account. Let's see profit and loss account for year ended. Closing entries for profit and loss account. For closing of all debit accounts related to indirect expenses, profit and loss account is debited to rent account, to salaries account, to electricity expenses account, to postage expenses account, to stationery account, to publicity expenses account, to other expenses account. And for closing all credit accounts of indirect incomes, rent received account is debited, interest income account is debited, other incomes account debited to profit and loss account. And for closing PLN account, in case of profits, credit side is greater than debit side. So, profit and loss account is debited to capital account. In case of losses, debit side is greater than credit side. So, capital account is debited to PLN account. Now, what is balance sheet? See, balance sheet is a statement showing the financial position of business on a particular day, in which the balances of assets and liabilities or receivables and payables are shown. Thus, balances of real and personal accounts are shown in the balance sheet on a particular day and at a specific point of time. Now, let us discuss the features of balance sheet. Balance sheet is a statement of position of an entity and not an account. Liabilities are recorded on the left side and assets are recorded on the right side. Assets and liabilities need to be shown in a particular manner, may it be in order of liquidity or permanency. As assets are not closed and transferred to balance sheet, these assets do not require any closing entries. Okay, let's see the format of horizontal balance sheet. Then a question arises, what are adjustments? See, adjustments means those entries which need to be passed at the end of the accounting period so as to arrive at true profit or loss and fair financial position of that particular business. Accounting treatments for various adjustments are: for closing stock, for accounting the closing stock after valuation at the end of the year, this adjustment entry is passed. Closing stock account is debited to trading account. It is presented in the financial statement as on the credit side of trading account, on the asset side of balance sheet. What are outstanding expenses? These are the expenses or part of expenses which are due but not paid. For recording the same following adjustment entry, respective expense account is debited to the outstanding expense account. It shall be presented in the financial statement as it is debited to trading and PLN account in case of direct expense or indirect expense respectively, on the liability side of the balance sheet under current liabilities. Prepaid expenses, the expenses or the part of expense that had been prepaid well in advance and actual occurrence of expense is after the accounting period. The entry passed is prepaid expenses account is debited to the concerned expense account. Its effect on financial statement: advance expenses are deducted from their respective direct or indirect expense forming part of trading and PLN account respectively. As shown on the asset side of balance sheet, what is accrued income? The income or part of income which has been earned but the amount is not received during the accounting year in which such services or goods are provided. We can see the adjustment entry passed. See, accrued income account is debited to respective income account. Effect in financial statement is it is added to the particular direct or indirect income falling under the credit side of trading and PLN account. And on the asset side of the balance sheet, income received in advance is the income or part of income which is received in advance before the service being provided or goods being delivered. Income received in advance. respective income account is debited to income received in advance account effect in financial statement. It is deducted from the direct or indirect income under the trading and PLN account respectively. On the liability side of balance sheet under current liabilities. What is depreciation then? The wear and tear of the depreciable asset due to its usage and other factors is known as depreciation. Adjustment entry is depreciation account is debited to the respective asset account. Its effect on final accounts. Depreciation is debited to PLN account. The amount of depreciation is deducted from asset and net value of that asset should be shown on asset side of balance sheet. Bad debt. The debtors from whom the amount of debt owed by them to us or portion of that can no longer be recovered, it is treated as bad debt, and the entry is bad debt account is debited to the debtors account. Its effect on financial statement, debit to PLN account deducted from debtors and net amount of debtors is shown on the asset side of the balance sheet. Provision of doubtful debts. It is a provision set aside for meeting any loss of bad debts that may arise in futures. Adjustment entry. PLN account is debited to provision of doubtful debts account. Effect of adjustment is it is debited to PLN account and deducted from the amount of debtors in balance sheet. Abnormal losses. The losses that have occurred due to natural calamities like earthquake, flood, etc. are called abnormal losses. Adjustment entries are loss on fixed asset, profit and loss account is debited to fixed asset. Effect on financial statement, debited to PLN account, deducted from corresponding asset account in balance sheet. Or loss to stock, loss by fire account is debited to the purchase account. Insurance company account is debited, that is amount of insurance. PLN account is debited to loss by fire, which is total amount of abnormal loss. How does it affect in financial statement? See, the amount of goods destroyed shall be deducted from the purchase account or can be shown on credit side of the trading account. Amount of loss irrecoverable from the insurance company shall be debited to PLN account, and amount admitted as claim by insurance company shall be shown on asset side of balance sheet. Goods taken for personal use when the proprietor withdrawn goods from his personal use from his business. Adjustment entries are drawing account is debited to the purchase account, capital account is debited to the drawings account. And how it affect in final accounts? Deducted from purchases in trading account or deducted from capital in the balance sheet. Now let us see the example of final accounts with adjustments and see how it is solved.